Are we on the verge of a financial tipping point as global central banks react to rate cuts?
Our journey today leads us through Jeff Snider's expert insights, unveiling crucial trends impacting our economy.
And the best part, you won't spend hours searching for answers.
Exactly. Discover how policies like quantitative tightening and quantitative easing influence your investments moving forward.
Welcome to Financial Insights in Minutes, your source for fast financial summaries of today's key economic developments.
Stay tuned as we delve into topics like inflation risks and what they mean for your financial future.
But first, let's dive into Eurodollar University for Jeff Snider's take on the global response to rate cuts. Time to navigate the currents of today's economic waters. Get ready as we explore how global central banks are reacting to the Federal Reserve's unexpected rate cuts.
Here's the full scoop. Jeff dives into the sobering reality of consumer prices potentially undershooting and what that means for the global economy and our wallets.
What's the heart of Jeff's argument here? Why are central banks worldwide sounding the alarm?
The crux is this. Many central banks are worried about consumer prices falling below their targets, what Jeff cleverly calls undershooting. It suggests we could be staring down the barrel of recession conditions.
So, what sparked this global rate cut wave?
Well, it all started with the Fed's recent cut, which set off a chain reaction, prompting Switzerland and the European Central Bank to consider their moves too.
What does undershooting really entail?
It indicates economic sluggishness, meaning consumer prices aren't just low, they're stagnating or even falling, which triggers alarm bells for central banks.
What are some specific fears from major economies?
Germany foresees a recession, as reflected in their declining economic data. The ECB also feels the pressure, having to adjust its projections based on poor performance indicators.
Let's peek into predictions. What does Jeff see coming next?
Expect a wave of rate cuts from Switzerland and Canada, potentially 50 basis points, driven by fears of undershooting inflation.
What about the knock-on effects for labor markets?
Expect deeper instability. Layoffs could rise as businesses react to these tough economic conditions, leading to even lower consumer spending. It's a vicious cycle.
Finally, what can we take away from all this?
Central banks must recognize the need for urgent policy changes to respond to economic weakness. Monitoring these trends will be crucial for navigating future financial storms.
But don't go anywhere. Next up, we'll explore insights from Professor Steve Hanke on why he believes the Fed has it all wrong.
Get ready for some eye-opening perspectives. You won't want to miss this.
Time to navigate through these waters of economic insights. Our next summary comes from the discussion with Professor Steve Hanke.
Absolutely. Hanke sheds light on the Federal Reserve's latest moves and why he believes they're missing the mark. Let's dive into his analysis.
So, what's the crux of Professor Hanke's argument?
He claims the Fed is flying blind, overly fixated on interest rates, while the true economic indicators lie within the money supply dynamics. The consequence? A looming recession.
Let's break down these critical points. What did Hanke say about monetary policy?
He emphasized that the Fed's focus on interest rates is misguided. With money supply shrinking, we're likely heading into a recession. Similar patterns have historically followed.
On to inflation. What's the story there?
Hanke anticipates inflation will stabilize below 2%, crediting the contraction of the money supply for this downward movement. It's crucial to watch.
And what's happening with the labor market?
Hanke predicts a weakening labor market as we move towards recession, with adjustments to previously reported jobs causing further concern.
What about the markets? How are they standing?
Hanke asserts that equity markets seem overpriced. With a potential recession looming, we could see a downturn.
And finally, what about global tensions?
Hanke believes current geopolitical risks are underappreciated in market valuations, which could lead to unexpected economic impacts.
What does Hanke foresee for the economy in the near future?
He predicts a recession will materialize late this year or early next. This trajectory is heavily influenced by money supply reductions.
And how will the stock market react?
According to Hanke, the market has not fully priced in recession risks, and we could anticipate significant adjustments soon.
To wrap it up, what's Hanke's main call to action?
He emphasizes the need to shift our focus away from just interest rates and closely monitor money supply trends for a clearer economic outlook.
But that's not all. Up next, we'll dive into core insights from Tom on massive dark pool transactions happen at the top.
Make sure to stay tuned. You won't want to miss what he has to say about the state of the market.
Time to navigate through these waters. Our next insightful summary revolves around the intriguing world of dark pool transactions.
Let's get straight to the facts. With significant market movements at play, Tom dives into what these dark pool activities could mean for investors.
What's the crux of Tom's discussion?
Tom asserts that dark pool activity, which spiked recently, is taking place at significant resistance levels. This could indicate upcoming market reversals or continued bullish momentum.
That market sentiment is crucial. What's the latest?
Indeed. 50.8% of respondents believe bullish trends are underway, yet many are apprehensive about potential reversals at resistance levels.
And what's the historical take on these rate cuts?
Tom notes that in the past, when the Fed cut rates, markets generally saw an average gain of 15% 1 year later. This pattern piques investor interest.
So what's in store for October?
October is typically volatile. As earnings reports surface, brace for fluctuations that could redefine market characteristics moving forward.
What do the predictions suggest?
If key resistance is broken, Tom anticipates continued bullish trends, potentially setting new market highs.
What's the flip side?
If resistance holds firm, Tom warns that a market correction could manifest, changing investor sentiment almost overnight.
So, what's the final takeaway?
Tom emphasizes that, while dark pool activities indicate strong interest in the market, the potential for volatility means investors should stay informed and cautious.
And what's coming up next?
Stay tuned for insights from Matt on our next video titled Live Pre-Market Prep, Markets Pulling Back from the All-Time Highs, Key Levels. You won't want to miss what he has to share.
Let's dive right in. Today, we're discussing the latest pullback in markets from their all-time highs. It's been quite a ride this September, and it looks like the currents are changing.
Indeed, the core theme from this session focuses on the market's reaction to recent economic signals and upcoming events that could affect trading strategies.
So what's the main takeaway from today's discussion?
The core thesis centers around navigating market volatility. As we approach key economic reports, traders need to stay vigilant and prepared for possible shifts.
What's the scoop on the economic signals impacting the market?
Recent Fed announcements suggest that traders might expect a rate cut sooner rather than later. Plus, many tech stocks remain surprisingly stable, defying broader market trends.
And how are markets reacting to these developments?
We're witnessing a cautious approach as investors reassess strategies, especially with tech stocks becoming focal points amid this volatility.
What strategies should traders consider right now?
Establishing clear entry and exit points is paramount. Traders should also ensure their portfolios are diversified to buffer against sudden market changes.
What do experts predict for the coming weeks?
Expect increased volatility as upcoming economic data could sway market sentiment. If inflation concerns resurface, corrections might not be far behind.
In wrapping up, what are the essential takeaways for traders?
It's all about caution and adaptability in these markets. Understanding economic signals can guide trading decisions effectively.
But wait, there's more. Up next, we have insights from Jim Thorne on interest rate to 2% next year as Fed saves economy from 4 horsemen of deflation.
Stay tuned for an intriguing discussion that could change your investment viewpoint.
Let's dive right in. Our next insightful summary explores Jim Thorne's predictions on interest rates and the economy.
That's right, Jim, with his extensive background as chief market strategist, forecasts a pivotal year ahead for interest rates and fiscal policies.
What's the core thesis of this discussion?
Thorne's thesis revolves around the prediction that high fiscal spending cannot be sustained, leading to a potential growth scare and subsequent interest rate cuts by the Fed.
Let's unpack the key points from Jim's analysis. First, the recent interest rate cut. What's the buzz?
Jim highlights that while markets reacted positively, history tells us that significant rate cuts often happen in turbulent times, raising eyebrows about what's really ahead.
What about fiscal spending? What's significant here?
Thorne points out that a 25% surge in the fiscal deficit poses serious risks. When spending is high and growth slows, the economy faces a precarious situation.
And what about the recession talk?
Thorne warns of a recession if private sector contraction persists, particularly as fiscal measures begin to wane post-election.
Time for some crystal ball predictions. What does Jim foresee for interest rates?
He predicts rates could drop to around 2% by late next year, although the actual economic impacts might lag until 2026.
What about the market? Any expectations?
Thorne suggests that while there may be a temporary shock from rate cuts, markets could stabilize, favoring innovative sectors like AI and Bitcoin.
To summarize, what's the big takeaway from Jim's insights?
As fiscal policy and economic strategies evolve, Thorne emphasizes the importance of being prepared for potential changes in the market's landscape.
If you're finding value in these insights, consider liking this video and subscribing to our channel.
Your support helps us continue bringing you valuable content. Don't miss out on future updates.
What a fascinating discussion we've had today, highlighting insights from experts like Jeff Snider and Steve Hanke.
Absolutely. Snider's analysis on consumer price undershooting really sheds light on how central banks are wobbling in their response to rate cuts.
And Hanke's critique of the Fed's decisions presents a compelling argument about the potential for misjudging the economic landscape.
Let's not forget Tom's revelations on dark pool activities hinting at shifts in market momentum. Those insights are invaluable.
Jim's emphasis on fiscal policy shifts adds another layer, indicating that we need to stay vigilant as these changes unfold.
So much to unpack, but one key takeaway is that the economic environment is poised for potential volatility.
If you found today's discussion informative, make sure to like this video and subscribe to our channel for more expert insights.
Absolutely. Your support helps us continue to provide you with valuable content that keeps you informed on critical economic trends.
Thanks for joining us, and don't forget to check out our other content for more financial insights.
Until next time, stay informed and keep navigating those financial waters wisely.